The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Welcome to Talking Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. Hello there, George. How are things? How's the summer treating you?
Hey there, Ian. Great to chat. The temperature is rising, and it's rising not just because of the great weather we've got, but also it's Q2 reporting. Generally, the companies are coming in line. Generally, guidance is disappointing, and companies hoping for a H2 bounce are lacing their commentary with caution. However, Ian, I want to sort of flip it back to you. You've been spending a lot of time thinking about the US market and reporting there. What are your thoughts?
Well, I've been going back over the Microsoft, Google, Meta's and Amazon results and trying to get my head round. Maybe I'm being an excessively cynical ex-broker, but what are they doing with their guidance? What are they doing with their commentary? It's clear that everything is going pretty damn well in the world of AI, but it's also clear that it's going, as far as I can work out, a lot better for the Microsofts and the Googles than it may well be for the Metas and the Amazons. Meta, to me, seems a little bit nebulous. Amazon is perhaps suffering from the fact it is the big beast on the block in terms of hosting, but it was the Microsoft and the Google that came through in terms of talking about things that are going positively and growth that we can sort of identify with, if that makes any sense to you.
That makes lots of sense. And also, I like the way you're thinking here, because with Microsoft, we've got a far wider product portfolio in terms of where to stick your dart that says AI.
I got the feeling coming off that call that they are sitting there thinking, well, this is going up 10 to 15%, this is up 15 to 20.
Yeah.
It really is a challenge to capital allocate at the moment and resource allocators to where do you think the next growth opportunity is for this business. And it's this sort of tie-in to where people actually generate value that I think Microsoft, I feel, has the bigger advantage over the other guys. Perhaps then you go down to Google, which is generating value in a more of a sort of a personal realm. And when it gets down to Meta, I have to admit I'm a little sort of scratching my head as to the use of the word super every 5 seconds by Mark Zuckerberg. I think Microsoft, I see nothing that can challenge it. Google, there are issues, and Amazon, I'm sure where that goes wrong, but I don't see where it goes right.
You started your commentary with, I think, an apology rather than a State of the Nation comment, which is, I might be a bit of a cynical broker here. And I think that's possibly coming out of your commentary, Ian. If we look at it another way, Microsoft is trading on 34 times PE. I think there's a huge opportunity in the world of AI, which is nowhere reflected in a company which is only trading on a 34 times PE. I see lots of opportunities. So in terms of trying to get my head around why is it valued so lowly, I think if we look at the sort of the application, the sort of the classic desktop side, there are lots of challengers in there. And in there, I think we're going to see more in terms of the competitive sides of AI. I think it's starting to be surfaced in the Bessemer Cloud Index. I don't know if you look at that one much, Ian, on a to-date basis. It's down 13%. Now, it was up 8% last year. And the view there appears to be the ability of AI agents to just take away swathes of the sort of classic SaaS desktop software marketplace. And you could say, well, we're sort of wishful thinking at the moment, but there are illustrations of these, and the industry is calling them AI agents, with a sort of a category of agentic AI, which is starting to make inroads into the corporate world. Now, it is very, very early, but what it is leading investors think is that, crikey, maybe we had a huge world of cloud and desktop people move to cloud. And now what do they do? And the concern is that that huge corporate franchise might be prone to shifting to new technologies which are AI native. And in there, we have a concern about Microsoft. Now, you could say part of that concern is built on, you've got once little companies like Salesforce, like Monday.com, new companies who are taking away bits of what you would expect a sort of, standard corporate desktop environment, common desktop environment to look like. But I think there's probably an even bigger concern that AI takes away big swathes of these classic markets. Where I confess I'm watching it most closely is the evolution of capita. You say, wow, George, capita is a million miles away physically and technologically, but they're really pushing the notion around agentic AI.
But is Microsoft not well placed to do something in this area?
Absolutely, Microsoft is very well placed in this area. I completely agree. But it's about the replacement of huge swathes of recurring revenue for something else. That's driving part of the concern in there. But going back to your first point around what a nice strong print, Azure is just knocking the house down. That's going really well. So you'd say, in terms of George, forget the front office. What are they doing in back office? They are still rocking the house there. No denying that.
But even these SaaS companies, the ones that you might regard as, they can get into the gap, they can threaten, they're either going to be running on AWS or they're going to be running on Azure.
Absolutely. It has to sit somewhere.
So there's always an upside somewhere for Microsoft almost.
There is. Think about it sort of relative to an SAP. SAP is building out its own data centers. You can say, well, they could go down that route. And if we look, let's say, the IaaS world beyond the AI big guns hosting the LLMs, the rest of the IaaS world is still growing pretty well as well. And I've got to put a big caution on that because this week we had Rackspace, and of course Rackspace is going through their phrase operational transformation. So revenue was down there, but otherwise that group is gaining ground as well as customers. And it's a big chunk of their customers are going to be the enterprise apps people are parking their assets with them. In addition to that, we've also got the notion around sovereign data. So people want to build up more localized data centers just on general concerns around data usage and governance. So Microsoft absolutely has a huge franchise. The numbers are great. My concern is the valuation. Why isn't it reflecting it? As I said, it's trading on 34 times.
But everyone loves to hate Microsoft. It's always been the same.
It has been true that everyone loves to bitch on them, but a superb playbook from Satya, a company that post the sort of the Bill Gates era, just looked as if it had lost its way. And he's deeply, deeply into cloud, deeply on Azure, and then widening into games, kind of an output, but much more widening the franchise into the B2C. So you cannot fault them at all in terms of their ability to execute and their ability to execute on a first-class playbook. But I think now the concern is what happens in the next step? What happens to the whole world of desktop? I was saying that, let's look at that valuation 35 times, who cares kind of thing. But Intuit is on 32 times. Sage is on 28 times. And that's where I struggle. Well, why isn't the valuation on Microsoft so much larger? What is the valuation telling us that we may not be aware of? And that's where I get to looking wider into the operational use cases around AI outside of the, hosting the massive data centers that, Microsoft can do so well. And in fairness to your point, yes, also has a position in that sort of agent builder marketplace where people are using toolkits from ML to build these little agents. But that is starting to happen. The lack of a swing up in terms of Microsoft, you could say it's everyone's favorite whipping boy. So it's never going to have this huge valuation, but it's got a great playbook. I just think there are concerns around the longer term viability.
But if things go wrong for Microsoft, do they not go so much wronger for so many other companies?
So we had this 2 minutes ago there, I was saying, Microsoft valuation X, Intuit, Sage there. And you think, if something goes wrong with Microsoft, because Sage is a core part of the ecosystem, and you'd say, well, co-opetition, sometimes they cooperate, sometimes they're competitors, so competitors on the Dynamics side, but Sage is a key user of Microsoft developer toolkits, you'd say, yes, there's a big issue for the wider ecosystem should that happen. However, what we're seeing over a longer term is more interest in open sourcing. So using software from more providers rather than from fewer providers. The problem with that is that if the two of us are sitting in a corporate procurement department, we want fewer software providers, but all of the development energy has been from a huge width in the industry of new software developers coming up with exciting tools that, for want of a better word, in the old days, your classic head of procurement would say, not on our supplier list. And one of the big changes has been these people saying, yes, bring them on, let's have them, because the underlying software itself, fit for purpose, it's been through our testing, we're using escrow. So that for me is a big change that's not really commented on at all. And that's the fact that IT buyers are themselves more entrepreneurial in terms of putting together their supplier lists.
Yes, an interesting challenge for them going forward. It's how do you justify your role when there is open source available, though, if you're a buyer? Although you're buying services as well as bits of software, aren't you? It has to be said.
Very good point. And you can just think right now, Cranfield or the Judd Business School is putting together that course. And that course is, how to be the orchestrator rather than the IT manager, sleeves rolled up, pocket protectors, let's get the code done team kind of thing. It's how do we orchestrate all of these services in order to deliver best products that solve business problems that are being sent down by line of business people. Then if we go into the cloud dynamic, one of the big things that happened then was, of course, the destruction of that central force around the IT procurement group. And so much more budget was starting to be held by these line of business people who would then sort of, tap up IT departments if there was an issue, but circumventing them as much as possible. The early days of Salesforce, they would say the last people to go into is the IT department. We will sell to you, sales team. So yes, so you've got that competing force on as well. But yes, how to manage my career in IT is a brand new challenge in the AI world.
Everybody's challenged by AI.
Absolutely.
One of the interesting things about all these results from the US majors was within the conference calls themselves. Okay, there was plenty of asking about returns. And there were plenty of conversations about we've won this client, we've won this client, we've won this client. And we are getting a return on our enormous CapEx, particular theme within the Microsoft conference call. But what no one was really going into is what are the customers actually getting out of it? They're getting interesting stuff and they're delivering returns in terms of customer satisfaction, ability to sell. But really, the cynical element in my head says, but if everybody's doing this, what have we actually gained? If all we're doing is selling the washing up bowl better, we're not getting a better washing up bowl.
And worse also, Ian, is on some of the calls, you're not getting great productivity improvements. You are in certain use cases or customer support. There was a couple of calls over there and they said, using this new agent, we're getting a 15% return on my investment. To go in and sell to a guy or gal, you've got all this existing stuff, how it works, it's reliable, chuck all that away and have this new tool. And by the way, you'll get a 15% ROI in it. They would just show you the door. And that's also been a surprise. Some of the returns haven't been as great. Now, at the same time, I am cognizant of a big UK government survey they did, and that was on Microsoft Copilot. Data's a year ago now, but they got some great returns on using that. Now, it could be telling us about UK government and civil service use prior to Copilot. Could also be telling us what they're using Copilot for. But that for me was a huge positive in terms of you can get decent returns as the user, as the consumer of the technology. So it's not just great, for want of a better word, marketecture that the industry has been able to sell. I think that there are some good returns in there as well. Are you, Ian, also a little bit guilty of remembering the sort of the post.com world where there were these huge investments in data centers?
Am I guilty of that? In a way, yes. But I think what's different then to now is that then we were talking about a grand universal change to the way things were working. Now we are still talking about grand universal changes to the way things work. But I think your commentary about agentic and Copilot and where it's adding value is, I think there's a lot of value in AI that's not particularly sexy in terms of filling in the cracks, making the little bridges. And that's not really how it gets presented.
Yes. I do look at the recruitment market, and there we've seen a big impact from Gen AI. The problem is that what we can't do is disentangle the big data to get to underlying drivers. There's been a big pullback in terms of employability, particularly at the entry level. Now, that could be programmers, but in fairness, it's also coming through into graduate recruitment as well. Now, you could say, George, you're just getting confused here. This is simply employers responding to UK NIC increases. Cost of people hire, so I've just got to have fewer hires. But the problem is that it's universal worldwide rather than just a UK thing. So we are seeing a switch in the nature of employment, and that will translate to basically fewer people, but those fewer people being more productive. And in fact, we're already seeing that in the IT services industry. As you know, that's a headcount industry. So if you want to have more revenue, you've got to put more bodies on the floor. And that's starting to break down this past couple of quarters. So that is coming together there. And those companies are early adopters of AI. And so, well, of course, they've got to have something to sell. If there is growth, it's there.
Turning back your internet question to me, back to you, is that we look at what we have here of Google, Meta, the companies have built themselves on pretty much dark fiber, as it were, the fact that the internet could take off at low cost because no one was charging anything anymore. What's the AI cold server farm product? What are the companies that can jump into that space? Is there a space that can be jumped into there? What can be done with free AI?
Everyone's answer to that's going to be CoreWeave, because CoreWeave has basically taken off on the back of that. But that's not really what your question is targeted to. So if I can put it from a personal perspective, search never evolved. People that are new in Google said it's all about selling ads. It's not about the development of search, not one iota. And today in the AI world, we have products like Perplexity, but it's not just them. There's a whole range of products. And they have completely reinvented search for the better. You can use paid or you can use free. But in terms of somebody that's a Google killer, there are now a number of Google killers there in terms of what the basic function for Google was for me, which was about search. Now for Google, it's all about selling ads. So they don't see it the same way.
Yes, returning to their conference call. Yeah, this was the big thing, which is, what are you about? Are you selling ads or are you providing information? And one of the interesting things that the management seemed to be directing everybody to was the youth engagement, the way in which different age groups are engaging in different ways with search and what people want to get out of it. As an old git, I'm not quite sure where that's all going to go, but it's interesting to see that what could be happening to inform and entertain people that we're just not getting at the moment.
Correct. But we've seen that changing usage patterns in different settings in the tech universe. So, once upon a time, the way to engage with IT was a punch card. It then became a QWERTY keyboard. It was green, and then it became color, and then you threw that away. So touch became the thing, and then it became voice. So we still have keyboards, but they are now less important. And if we look at big consumer apps, it's about switching. It's not haptic yet, but that's the way it's going to go. So you can see how bits of the tech industry have started and then they end up completely different. And for me, Google sat on search and didn't develop it. Bing came along, which is just another search. Now, both of us, Ian, used different products prior to Google, and they were good, successful.
Yes.
And Google came along. It wasn't the search; it was just better selling.
It felt easier to use,
Yes,
and initially felt uncorrupted in the naive early days of the internet. I have to say that perhaps a more surreal element of the Meta call was the Zuckerberg complaining, or seeming to complain, that AI had developed a little bit too fast. obviously don't listen to all these conference calls all the time, but it was jumping back into the meta world and forget just how properly bonkers it is. Whilst it is a fabulous company and fabulous in terms of what it does and what it's achieved, he's still talking about glasses and referencing things like holographic. So maybe that is the sort of second leg to the meta vision. Maybe the metaverse is it. Maybe we're all missing something in terms of we're all going to live in the metaverse dictated by AI, and we don't have to do anything because it's only virtual anyway.
Wouldn't that be great? So, Ian, I was going to say you could be sailing down the Medway and your agent is doing your work for you. Wouldn't that be great? Your agent will then only come to you when there's a problem or a conflict or a hallucination that they have found. But if we go into the recruitment world, for both of us, it's basically economy gets a little bit better. You hire more people, that drives growth. And now we're coming to a scenario where people aren't being hired. People in jobs are afraid to move because you don't want to be the sort of the last man in anywhere. And I can start to feel the productivity improving. So for me, we could be looking at a structural change anyway in the nature of what we all do, how we do it, and how we're judging quality of life. But there will be a scenario, as both of us see in industry, of digital twin. And absolutely, it's a B2B, it's a bit too geeky for everyone, but we can see the development path there start to come into our personal lives. Way too soon. Technology isn't there. Culturally, we're still too far away from it, but we can see this just extending everything by time. I think for Mark Zuckerberg, it's the disappointment that he's missed out. That's why he has to keep on talking about it. I don't know if you saw Anthropic is now sort of giving people bounties of 300K. They want to capture the best AI developers. They see this huge opportunity.
But they are lagging.
But it comes from people. It comes from motivated, on with the people. As you were talking about sort of sitting in on the US conferences, we're both reminded of Palantir for the best evening out. You should be paid to attend the Palantir conference for what they come out with. But where they started was by overpaying for software developers. And they built it that way. So have a great talent pool.
So people from Palantir know what they're doing. People from Microsoft know where they're going. People from Amazon know what they're doing. People at Meta, we're straying, as it were, from the central theme.
Possibly a bit harsh, but I'm reminded of Meta when I think about Google, in the sense that somebody had a huge franchise around the Facebook and then failed to evolve the underlying value proposition, just as Google had search and then failed to, because they're pointing somewhere else and they forget this is why people come to us. This is the purpose. And then, Ian, I loved when you started talking about the generational, what are different generations thinking about and using, which cropped up on one of the calls, because, people don't use Facebook anymore. And that's a big hole in terms of Meta, given what it could have been had they continued to invest in developing along that to create the personal digital twin. That's still a huge prize and a huge franchise for someone.
Maybe that's what we're all missing.
Possibly it's multiverse. If you talk to gamers, they will scream the underlying opportunities around multiverse. But at the same time, gaming is also one of the early adopters in terms of AI. But they say, well, it's not for text or search. It's basically what it's doing in terms of, rendering and just creating amazing graphics, filling in the people in the background, which is where I dwell usually.
We have, yes, Meta is AI 2.0. Let's just wait and see, shall we? And if you want to get away from AI, of course, you can come back to the UK, as we can see with the FTSE, which has risen quite strongly this year, up 11% or so.
Ring a bell.
Ring the bell.
Up 11% year to date. Isn't that amazing?
Yes. But the thing I am still struggling with is that we can hear this noise saying, yes, fantastic, the UK market is being revalued. We're going up 1 or 2 PE points. But when I come back to the UK, where are our growth companies? Where are the companies we try and like to talk about? They're all off. If we talk about Capita off this year, Dot Digital off this year, Computer Centre off, Bytes off, Kainos off 30-odd%, GBG off 30-odd%, Cerillion How on earth could that be off? Raspberry Pi is up on a 1-year basis.
Stop. All you're doing is just going to talk through a long list of companies. So we know that the tech sector is TSR minus 11%
Yes.
this year. So yes, we know that. However, let's look elsewhere and let's look at, say, Techmark. Techmark is up 12% year to date. What we're doing is mirroring what's going on in the US. So I talked about Bessemer Cloud being down 13%. Now, NASDAQ is up 12%. The market at the moment is looking for different kinds of winners. And as both of us know, Techmark, as it differs from the classic software and computer services index, has more of, say, the defense stocks in there. It's got some of the aerospace guys in there.
The electronics, electricals, these kind of things. Things you can
And
kick.
it's those that are doing really well. Now, you gave yourself a hint because as you went down your long list of down, you said, oh, hang on, Raspberry Pi is up. And one of the positives has been on the hardware side this year. You are in clover, Ian.
Oh, I can't be completely in clover because Raspberry Pi is actually down year to date, up on a 12-month basis. The basic message is there. But I do worry that we are getting overly G'd up about the potential for IPOs. And when you come across to the UK, is the UK really getting behind technology in the way it should? Is it really getting behind growth? Especially when we look at where the market flows are going in terms of the capital, the investment outflows out of the funds. The UK investors are still leaving UK funds, and it's the international boys and girls who are coming in. That's not a long-term story, and it's not entirely comfortable.
Yes, that is correct. The other side is that there's been big outflows in terms of M&A. So the sector has lost a lot of companies.
We have been reminded that these UK companies can be good companies, even if we don't recognise it on a day-to-day basis. So there is a rationale for reinvesting back into the tech sector rather than taking your £10 million from someone overseas that you've just sold your UK listed business to, tech business, and then sticking it into a UK retailer, which is all too often been the problem. We talk about, whatever happened to the money from ARM? It's just got spread everywhere, didn't it?
It got spread everywhere. At the same time, Ian, surely institutional investors are feeling somewhat embarrassed by your argument now, because that has absolutely been the playbook. Own a tech company, it gets taken out, and then invest in oil and gas. And I think we should be supporting this sector. Now, at the same time, because they do come in, they stay on the market for a while and they get acquired. As that playbook just gets more and more visible, and we saw it with, dark trades, we saw it with Sophos and Avast as well. And one of the IPOs that people are talking about is Visma. So Visma is a Norwegian company. It's a Sage lookalike, i.e. it does accounting and then sort of, whole odds and sods of payroll, tax, invoicing software. That's going to be spun out of HG. Now, they had their H1, Q2 results last week. ARR for them grew organically just under 11% to euros 2.8 billion. And they can come to market, although talking about difficult, slower economic activity, lower growth in payroll and invoicing, they can still come to market because all they have to do is price themselves around Sage. And as we've already discussed, that sector is flying from a valuation perspective at the moment. I think UK investors will look at that and say, well, that will probably get acquired in the next 3 to 5 years. And typically mid-cap ones, and clearly this would be a large cap one, will make their money. People sometimes think if you list in London, you don't get access to global investors. That is not the case. Global investors are global by their nature, and they will be pricing it off, an international peer group of which Sage is only one component. We talked about, Intuit earlier, trading at 32 times. So, that will be a great success, and they will still talk about difficult underlying markets because that is actually what's going on. But the function of them coming to London is really about good market timing, the price that's being paid for similar assets on public markets. And HG gets to gloat about its playbook.
Yes, demonstrate that they work. Otherwise, you can't keep these companies going forever without actually demonstrating some realization of value.
Completely agreed. Big recurring revenue, investors will lap it up.
It would give a large global player an extremely good market share within the SME market, would it not?
And of course, yes, it'll go for that very reason, absolutely, and get acquired in time for that very reason. Just not this year. This year, it goes to PLC land. So that's a positive, and hopefully that creates a broader lift, and then more companies then feel encouraged. For me, the real pain in this goes to the smaller companies, where London has a global franchise in bringing smaller companies to market, beating America, beating everyone in Europe. And the issue is that we're not seeing enough there. I mean, they are the lifeblood in terms of running transactions, raising money, doing secondaries, and we're not seeing those at all. And it's as if the sort of the barrier is lifting, whereas for me, it should actually be lowering to encourage these earlier stage companies to come in and really start to be a competitive force against the VCs who are now doing Series G runs, holding on to companies, for me, far too long.
But do they want to do a Series G? This is part of the mutual misunderstanding, perhaps, between UK listed markets and the whole VC thing, is that the acceptance, perhaps, on the part of the PLC world that you're not going to get the very best, because the very best, they don't want to sell. Why should they want to sell it to you? What they want to sell is the stuff that they want to not spend the money on because they're going to get a different set of returns. They're going to have to work it in a different way. They're going to be selling into the PLC market the stuff that's 10 to 20%.
Yeah.
Which, when you start to look at them as a greater pool, then you can start to think, well, actually, if the PLC market is about these companies that can grow on their own 10, 20% organic, and they can do acquisitions and transactions between themselves, agglomerate themselves, grow to bigger businesses. Yeah, they're not going to be the sexiest businesses, but does that really matter? What we're trying to do is to keep the PLC market growing for the wider economy, not to have the very best. Realistically, we go back 20 odd years, not even that long. What would be the need for Google, for Facebook, whatever, to come to market? Would the VCs, take them back in time, still be letting them go in the same way that they did then? I don't know.
Ian, I think you've solved so much in this commentary. This conversation this afternoon has all been about companies on a journey, and they change over their life. And it's probably even harder for software companies, because software companies, their life is going to mirror product life cycle, and that's going to be there. And one of the joys of those companies, as you're describing them, is that they are going to institutional investors and saying, we're not fully formed yet. You're going to give us money. We're going to deploy this capital, blah, 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 blah. In 3 years, we'll probably be a completely different beast. And it's that ability to grow on public market where everyone appreciates and understands the risks. And I understand that on that, you will have an hours long debate anyway. But that is one of the glories that they can do. So all of that growth then happens on the public markets. And you don't need to come to market as a fully formed, everything's done. I'm Series M. Everything's done. It's not that, because institutional investors appreciate software industry dynamics, that they will change over the number of years. And the company you're buying today is absolutely not the company that will be there in 3 years' time. And then hopefully the investment bank will sell the deal in terms of the IPO to those long-term investors who understand and appreciate that, rather than to more short-term oriented investors who are looking for, a quick flip on the day one pop. But what you've addressed is, for me, one of the great untold stories about why London does really good smaller company IPOs. It's that ability to have that perspective over the longer term. Hopefully, that's not something that's lost as the rules and regs in terms of what can and what can't IPO are changed.
We have the question of why has the LSE spent the last 3 years, whatever, chasing after Chinese retailers and very large challenger banks, fintech companies. And actually, it has to be said, Pamela Gordon recently put out a great big long list of fintech companies. You can check your LSE posts as to how many times those companies have been mentioned by the LSE as potential IPOs. Many of them are potential IPOs. but they're just not the big golden goose that certain people at the LSE seem to want. It seems to be sort of detached from how modern financial markets work in terms of private-public interface.
So as we both know from all of those years sitting and listening to Fidessa talk, and then earlier listening to Mises talk, one of the vagaries of the London market is that London really likes, i.e. ascribes a higher valuation to fintech companies. We're all in the ecosystem. We understand how the end markets work. We understand how the money flows in these. So London's a great place for fintechs because, for whatever word, we all get it. There's a community there of buy side and sell side who can say, yes, I can get my head around that. And from that knowledge, then people have historically just ascribed far higher multiples. More parochially, in terms of why does London do all of this fintech? We were first in terms of open banking APIs. So a lot of the stuff happened here. And people who were developing software came to London because of the experience of open banking APIs. There was a Norwegian company I spoke to recently. They were number one in Norway. They moved to London because they want to be number one globally. So their footprint is now in London. And it's because of the experience that we've got and the underlying technology around open banking. And in fairness to London, we now have groups of consultants traveling the world, telling the rest of the world how open banking APIs work. So, of course, Panmure Gordon should have a big, long list of potential companies who could do stuff. But that would be a great illustration of research getting out of their desks and talking to companies, because there's lots of interesting companies there. Now, clearly, with the benefit of hindsight, you're going to say, George, the last fintech that came to London was Cab Payments, and only took 3 months to warn, and is now sitting on a very, very healthy discount to its IPO, which was only last year.
We've discussed it before that Cab Payments, the risk was not the technology, it was not the business model, it was the markets and what goes on in the markets.
Absolutely, absolutely.
That was quite evident.
You only have to mention Nigeria to get everyone's interest.
Nigeria, there's a finance story there.
Well done, Panmure, for doing some work on the companies.
I wasn't that impressed by the fact the second one on the list was Constellation, which is a car retailer, but there we go.
What? I'm reminded, in my Lord's house, there are many rooms. Some say car dealers. Others say do not disturb. So, Ian, our theme for the summer is sadly not roll out the barrel, which is what we both want. It feels where this conversation is headed more like Summertime Sadness by Lana Del Rey. Now, I can say that because not only did she sell out Wembley, but she's moved on to pastures new.
I was going to say, actually, in terms of pastures new, one thing that should be mentioned at the end of this, Steve Shirley.
Oh, very good. You are a gentleman. Yes. What do you say? An icon has passed. She has done so much work creating a sector in terms of FI. For my sins, which are many, I'm a member of the Worshipful Company of Information Technologists, and she created that as well. So she was huge in terms of not just the techie thing, but philanthropy around it, and created an amazing company. You'll recall FI was the company that took on women to enable people to work from home and work remotely so they could have balanced, blended careers. And then, of course, there was the ISI acquisition, I'm going to say in the mid-90s, could have been either side of the mid-90s, the first in terms of buying a big offshore footprint to educate those of us in the market, if not those in terms of the buyers of technology, how tech was a fungible skill and people from there could do it here, but at vastly different price points. So one of the first customers in terms of early adopters was a certain Scottish bank, clearly didn't believe them. So had all of the Indian programmers shipped to Edinburgh in a trice, eroding the whole point of it. But a huge, huge loss to the industry, and a huge loss, yes.
Yes, truly amazing woman.
But on that bombshell, thank you so much for your time and thoughts.
Talk to you next week.
Ian, have a super week.
And you.
Brought to you by Progressive Equity.